Well, welcome everyone to today's webinar. Very excited to have you all here, and thank you all for joining us today. We've got a great webinar put together and really excited to go through it with everyone. I do want to thank everyone for submitting their questions. That definitely helps shape some of the content that we cover throughout these webinars, whether it's the market update webinar or some of the other topics that we cover throughout the year. As we progress through today's webinar, please submit questions through the chat box. We will try to get to them at the end of the session, but if not, we will make a focus to get those answers to you. And we've been covering the questions on future podcast episodes. And you can check that out at keenwealthadvisors.com under the retirement resources page. You can see our all of our blogs, all of our podcast episodes, and also replays from our previous webinars. So lots of great content out there for you to consume. In addition to our blog and podcast hosted on our website, we also have launched a new YouTube channel. I encourage you all to check that out. We will have replays hosted there of our webinars. Also, as we record the podcast, we will have video versions of the podcast, and we will have additional content that isn't found anywhere else, but just on our YouTube channel. So check that out and subscribe to that so you can get the updates as we post new information. So let's talk about what's been going on here in the financial markets. It's been a great start to the year by all intents and purposes. I mean, this is a graph going back to beginning of the year through the end of Q1. So this is through the end of March. And you can kind of see how the markets have performed. I mean, pretty steady, significantly higher at the beginning of the year. I mean, if you were to annualize this, you'd say, okay, well, the S&P 500, the NASDAQ, all these different kind of asset classes. I mean, we're looking at almost 40% annualized on the S&P 500. But we know markets don't just go up in a straight line. There's volatility associated with investing. And the financial markets, they trade every single day. When the markets open between 8:30 and 3 here in in the central time zone, and they fluctuate. And that fluctuation is just part of the process when it comes to investing. And so we've had a pullback. Now this is through April 21st, and so there's been a little bit of a recovery in in the markets. I mean, the markets are still higher, and to say that we're close to 5% on on the S&P 500 through almost through the end of April, which would be a compounded annual growth rate of 14.5% from from this point forward. There's just this fear that, like, well, it's starting to go down. What's going on? Is there something wrong? Is this the start of something? What do I need to be doing? What do I need to be aware of? That's what the financial media makes you think you need to be focused on. And if you've been a long time listener of our podcast, reading our blog posts, paying tuning into my webinars, you'll know that's not the case. But it still doesn't change kind of the narrative that the financial media wants you to think that, hey, you need to be doing something because there's all these concerns that are out there. And then on top of that, we have an election year too, which also adds a different level of I would say, I almost want to say anxiety, but people are just interested in, hey, what's going to happen with the election and how does that impact the financial markets? So this is going back the last 12 months. And again, these different asset classes, the reason I show all of them is because this represents a diversified portfolio, at least from when you invest in stocks. And it's by all means not everything and all inclusive. This is just a a selection of the major ones that we focus and pay attention to. And the biggest best performer over the last 12 months is NASDAQ, is what's listed here, the purple, and that's a basket of primarily of tech stocks. Then you have the S&P 500, which is more broad-based, 500 of the largest companies here in the US, which still has a large weighting to technology. And then you're followed by the Dow and small companies. Then we have international companies here at the bottom. But over the last 12 months has been great. And this is through the end of, April 21st when I put the slide together, and it includes the pullback. And you kind of see here, okay, well, this most recent pullback, I mean, it's even over the last 12 months, we've had volatility. We haven't just gone straight up. So this volatility or this pullback isn't something that's just new to today's market. But again, we live in the now, the present. So again, that those pullbacks can be concerning. This is going back the last 3 years, includes the dip and correction that we had in 2022, and then the subsequent recovery since then, and then the last 5 years. And what you can see here is that volatility is just it's part of the process, and we account for that in our portfolios and how we manage money for clients. We know things will fluctuate, and that's why we have, not only, especially for retired clients who are not adding to the portfolios, but potentially even pulling distributions out, we have other investments, typically kind of fixed income or bonds, that we like to call it, that we utilize for your income needs in periods of volatility. Let's, kind of talk about bonds here in a moment. Here are the different sectors going back the last 12 months. And you can see energy has been a significant performer. Now, if you go back last few years, energy, it would have good years and bad years. It can be very volatile, kind of based on what oil prices are doing. And then communications, financials, see here how things have switched a little bit. Technology, while one of the best performers over the last year, has really been stagnant over the first 4 or 5 months of 2024. And what this tells us is that things just go in and out of favor. So moving on to bonds, there's kind of two components of bonds when you look at fixed income. So it's what is the value. We deposit money into a bond. We loan money to the U.S. government. We loan money to banks via CDs. We loan money to corporations when we purchase bonds, and we expect to receive that money back. And in return for that loan, we receive a rate of interest. And interest rates are a function of a lot of different things. I mean, part of it is, what's the credit quality? Is there a risk of default? Am I going to get my money back? Because if there's a higher chance that you're not going to get your money back, doesn't mean you won't. It just means maybe the likelihood of this company paying you back is lower. Then they have to pay a higher rate of interest. That's credit quality. And then you have, government bonds, like specifically U.S. government. Well, there's never been a time where the U.S. has defaulted on their bonds, meaning they haven't paid your money back. So there really isn't any credit quality risk. Now it's just, what's the opportunity cost? Because if we, put money in a bond and we earn a rate of interest, well, that it's tied up until that bond matures, unless we want to liquidate that bond. We can sell it to someone else who might be interested in it. And the value that we're going to receive for that bond is based on current interest rates. So that's where interest rates really do kind of have a big component to the value of bonds, CDs, everything else that's out there. And interest rates have been, this over the last 12 months, they've been fluctuating, but in a little bit of a range here. I mean, you can see as low as, going back 12 months, as low as 4% on the 2-year Treasury, up to almost 5% today. But that's where it's been higher going back to last fall, and similar yields on the 5-year and 10-year, which you can see represented here in the kind of gold and light blue on the graph. Interesting. This has not been this is nothing new. It's been this way for a little bit of time here. Is the 2-year. So when you loan your money to the government for 2 years, you actually receive more interest than if you were to loan your money to the government for 10 years. So we call that an inverted yield curve. And I've been talking about that for some time, and I do have a future chart on that. And essentially what that means is that current interest rates, short-term interest rates, are higher than long-term interest rates. So whether that's the fear of, well, yeah, current inflation's high, so we want to make sure that we're getting compensated for the current kind of market investing environment, economic environment that we're in, but future expectations for inflation aren't nearly as high as they are in in the current market. So that's where yields are less, because people expect interest rates to come down between now and 5 or 10 years. This is the value of these different asset classes, these different bond asset classes, based on what's been going on in the interest rate market over the last 12 months. And so the way to understand this, the way to think about it is, when interest rates go up, existing bonds go down in value temporarily. I mean, it's if you don't sell the bond, then the bond matures and you receive the principal and interest while you wait. But if you needed to liquidate it, well, here's where the market is saying, here's what we'll give you for it, because participants are looking at that and saying, hey, I can get a higher rate of interest by just going out and buying a current bond instead of buying your bond that pays me less interest. So to do that, to be compensated for that, I want to pay you less for it. And that's what this reflects, is kind of how those values have changed over the last 12 months. This red line, you might think, well, that's interesting. That's just kind of gone straight up. Well, that is a very, very short-term bond ETF. It's a basket of bonds. All of these represent baskets of bonds, and just pays kind of just a rate of interest, almost like a money market account. And over the last 5 years, up over 5%. Not a whole lot of volatility associated with that, because those bonds mature, on average every 3 months. So there's not a lot of risk from interest rates fluctuating, because they're constantly maturing. Now, when you own a longer term bond, there's government bonds that are 30 years in length. We call that duration, and that's represented by this gold line here on the graph. And this is anything that's more than 20 years is in this basket. And you can see, well, as interest rates have fluctuated, the value of that basket or ETF does fluctuate a lot. I mean, look, at one point in 2023, I mean, look at, if we just go back to the end of April, because this is going back just 12 months, end of April 2023, the long-term bond through, call it end of October, so about 6 months, was down almost 20%, because you have a long period of interest. So when you kind of lock it in for long term, that volatility is really just tied to interest rates. And then interest rates came down, almost got back to even, and then now they've gone back up a little bit, and you can see how that bond fluctuates significantly. And all these other lines represent just shorter maturities, meaning your money is not tied up as long, and you're able to reinvest at whatever the current rates are. We focus a lot on the short-term bonds, and for a couple of reasons. One, we don't want to have volatility associated with that piece of the portfolio, or we want to minimize that as much as possible. That's the objective, because if you're pulling out money, we want that money to be stable, and especially in periods where the stock side of the portfolio has volatility associated with it. So we don't want to take on extra volatility when it comes to the fixed income side of the portfolio. I know we've gotten a lot of questions on that, and we'll continue to discuss that, throughout the year and ongoing, because that's a key kind of component to how we manage the assets here at Keen Wealth. So let's talk about the economy, because, okay, this is what I just reported with the charts and graphs. That was history. Now it's all about, well, what's going to happen going forward? And we don't have a crystal ball here, but what we do like to look at is what we call leading indicators to give us an idea of where are we in the business cycle. And I'll explain how that all works. I actually have some additional slides on that, because if we can get a sense of where the economy is headed, that can give us some insight into what the stock market could be, how it could be performing going forward. So we're going to talk through employment, retail sales, building permits, business spending, and the yield curve. And there's more leading indicators than this. This is just a subset of some of the bigger ones that I think the market focuses on, especially in today's environment. And I've been covering these specific indicators for some time now. Well, this is the jobs market, and this is a very important data point, because our economy here in the U.S. is based on consumption. And if people have jobs, they consume more. If jobs are being lost, if people are getting laid off, well, then there's a lower probability of consumption, which means less economic growth tied to that. Here, this is going back pre-COVID, we had 152.5 million jobs, people working here in the U.S., counted in the labor force. I mean, this is just the people working out of the entire population. And then currently 158.1 million. So you can see how that's been increasing ever since the COVID hit and the government shutdown and everything related to since that. We have since recovered all those jobs that were lost and now have grown. All of these graphs that have the word Fred here in the corner, these are from the Federal Reserve, and there's a website. It's actually it's maintained by the Federal Reserve Bank of St. Louis, but this is, it's all Federal Reserve data. And if you ever want to look up all kinds of data points, they do publish it there, and it's fred.stlouisfed.org. That would be the site to go to, and tons of information on there. I really enjoy going to that and looking up all of this as kind of a economic data nerd. When you see these gray bars, anytime on these Fred charts, and this is pretty common in most of the graphs that I have and charts that I have, is these gray bars represent recessions. So anytime you see that, that indicates that the economy was in a recession. These are all the job openings here in the United States. This is going back to the early 2000s. And you see how, yeah, we had jobs, or at least jobs are published as unfilled, they're openings. And then as those get filled, they either drop down or new companies get started and replace those openings with new openings. We're still at a higher level than we were pre-COVID, but that number has been coming down, which is a good thing. I mean, when we have a lot of job openings relative to people looking for work, well, that can mean that there's a shortage of labor. And then to fill those positions, then companies have to pull or incent employees to come from other companies, which means the current company that's hiring them doesn't, loses that worker. And that might be good for the worker, because there could be higher comp, better hours, all these different things of why they would leave. But we'd like to have, you'd want to have workers. I mean, that is one of the key growth components, is number of workers and productivity of those workers. That's how economies grow. And if you don't have enough labor, well, then the economy can be, it's just not at full capacity if if there's a shortage, even if you have extreme productivity, and technology can help along that productivity side, but you do need a growing labor force to continue to grow the economy. But the good thing is companies are still, looking for workers. Initial claims, this is when people first get laid off. And another key component here, because this just tells us like, okay, people are, if there's a spike in this, and it looks like it's been, increasing, it's been in a very tight range. You can see 2020, we were at 1.8 million of folks that were just filing unemployment claims. We're the same level that we were kind of pre-COVID. There was a significant, increase here during COVID, but that's been slowing down. Before we enter into a recession, you'll typically see this level of claims start to increase. And again, this is why it's an important indicator for us. Retail sales, as people consume, I mean, they spend money, and there's a lot of money spent in in the retail locations. That number continuing to increase, and it's okay if it slows down some, but we do want to see it steady, a steady increase over time. Building permits. This is just permits for new housing. A lot of jobs tied to housing, a lot of money involved in housing, and this number has been, it spiked post-COVID, but it's been on a continued increase even after the recent decline in new housing that was tied to primarily the increase in interest rates. And one of the fears was that interest rates are going to increase so much. And, they did increase a lot during 2020. I mean, we basically kind of went from 0 to over 5% over a short period of time. And the fear was, hey, housing now is a lot more expensive, which is true. I mean, mortgages, the cost of a mortgage is more expensive. And what's that going to mean to the housing market? A lot of fear that housing would crash. It definitely slowed down, but it's not. I wouldn't say it's crashing. If we, this red line here, if you look and just visually kind of see, well, it's still on trend, kind of post 2008, 2009 financial crisis. If we were to just draw a trend line, yeah, there was a drop COVID, recovery post-COVID, but then now trend line is resumed. So housing, by all intents, I wouldn't say that's a crash in housing by any means. And there's additional data to even indicate that housing hasn't crashed. And one of the things that's just a known issue is that the inventory that of housing available just there isn't enough of it to satisfy the demand for housing. So this is going back 1982. You can see this is the inventory of new and existing single family homes for sale. So there was a lot of inventory here pre 2008, 2009. This is the peak of the housing, bubble, if you want to use that word. Then we had that come down, and there was a lot of speculation in housing. There was a lot of loans that probably shouldn't have been issued, and loans that really don't exist in today's market. Now, housing took it took a big hit, and it still hasn't necessarily recovered for the average since the early 80s of homes for sale. So we're still kind of lower than where we've been historically on inventory. And that's one of the things that's keeping home prices from cratering. If there was a lot of inventory and interest rates spiked, yeah, we would probably see a significant drop in home prices. But because there's just not a lot of inventory, it's keeping prices higher. It's just kind of supply and demand, how it works. Now, this graph here on the far right, this is the an index, a way to measure home values or home prices on a year-over-year basis. So this is going back January 2023 to January 2024. The National Home Price Index went up 6%. You can see all the different cities here kind of represented, some of the major metro areas. So again, housing not crashing, which was a big fear of a lot of folks. Businesses are continuing to spend. I mean, they're not, what we're more concerned about is a big drop off in spending. I mean, it's been very steady, so very good from a business spending standpoint. And then the yield curve. And the yield curve, what this is representing is that first graph, or the first fixed income graph that I showed, where it showed the 2-year government treasury is paying higher interest than the 10-year. And this looks at the 10-year government treasury compared to the 3-month. So you can get higher interest on a 3-month, or very close to it, on a 3-month government treasury versus locking it up for 10 years. And the reason this is important, because this indicates that financial conditions are tight when this happens. And historically, yield curves have inverted prior to recessions. That's what all these red circles indicate, is prior to a recession, yield curves have inverted. I've written this one a little different here because this is the COVID recession, and that was more of a government mandate than it was related to financial conditions in the business cycle. And then here's where we are currently. Now, I've said this for some time. I believe that we don't want to use the words "this time is different," but we do have to take some analysis to look at and say, okay, is this similar to these other periods, or what is different and what is the same? Well, one of the things that I think is different is that the government has been, and specifically the Federal Reserve, with their what's called Federal Open Market operations, has been very active in the government bond market, and have been utilizing the tools that they have. They're all transparent with this. There are tools that they use to keep interest rates in a certain range. So they control the one rate that they talk about, and that is the overnight lending rate, is what they charge banks basically to borrow from the Fed. And that's where money markets and CDs are all kind of keyed off that. And the rest of the bond market is driven by supply and demand. Well, the Fed is also one of the people out there that is purchasing or selling bonds in the open market, which is influencing supply and demand, which influences interest rates. And they've been more active in the last, even you can go back here, 2008, 2009, in the market than they have been in the past. So there's some things here that wouldn't indicate that it's just the business cycle or financial conditions. There's also the Fed, who is dumping bonds or letting them roll off their balance sheet, which is impacting the yield curve. Let's talk about earnings. Earnings is such a important component of stock prices, because stock prices are all a function of earnings. And it's just, okay, what price is the S&P 500 or any stock? Well, it's like it's a component of how much money that company makes. And there's no right or wrong way to look at it or formula to say exactly that, hey, this company has this amount of earnings and this is what it should be worth. But analysts and others, they come up with price targets based on future earnings, and then they discount those earnings based on current interest rates. And what the market looks at is, okay, well, what are earnings expectations for the remainder of this year and next year? Because as investors, we're going to price current, what we think the market should be worth today based on what we think earnings are going to be over the next next couple of years on a very short-term basis. Over time, you can see how earnings increase. I mean, current year 2014 earnings were $119 a share. Ending 2023, $220 a share. I mean, earnings go up. I mean, that's just what happens. And you can go back, previous, a lot farther on the earnings data and kind of see how it goes up. And that's where stock prices kind of follow earnings over time. And it's not an exact one for one, but expectations for 2024, about $243. And then for 2025, $277. Well, why is this important? Well, especially you might think, okay, 2024, what does that mean? Well, as the markets move through time, through the year, we price current value on future earnings. And as we progress through 2024, the year-ending value of the S&P 500 is going to be on expectations for 2025 earnings. So if we have an earnings per share estimate of $276, we apply a multiple to that, and that multiple is based on a lot of different things. I mean, it's current interest rates, it's future interest rates, it's just what's the current market environment expectations. I mean, every single day that multiple can change. Again, it's not like this set formula, but I like to provide this framework so people understand when we talk about what we think is going to happen throughout the rest of this year and even into 2025. Well, what are we basing that on? And this is one of the components that we base that on. So if we were to apply an 18 times multiple to $276, we would say, okay, that equals 4,968. Well, I'm using the S&P 500 because these are the S&P 500 earnings estimates. And again, that's 500 stocks. I mean, it's a broad basket, good measure of just US kind of large companies. And if current value, which this was current value of the S&P 500 as of April 21st, 4,967, we're right in line with year-end estimates at an 18 multiple. If we apply a 20 multiple, you can see year-end price target of 5,500 and a 22 multiple year-end price target of just over 6,000, which means there's a range. It could be flat, which doesn't include dividends, but could be flat to up 22% by the year end. And that's from this value on April 21st. And that's a big range, and there's a lot of factors that will kind of come into play, and that's why I provide a big range. But currently the market is around the 21 multiple. I mean, that's where it's at based on the previous 12 months earnings. So it's like, okay, current multiple, future multiple, where do we see things progressing? And what I believe is that, hey, we're probably in, between 20 and 22. That 21 is it's a current price based on what's going on in the market, and I think that will continue to be the case, which gives us, a really good price appreciation between now and the end of the year. Even with the election and everything else going on, I still think that is reasonable. And I'll provide some additional information that kind of supports that. Interest rates, current interest rates, there's a range, 5.25%, 5.5%, because it kind of fluctuates a little bit on each day. Year end, 4.5% to 5.5%, meaning a 1% drop to basically no decrease in interest rates. Now, what my last webinar on this was end of December, and the expectations for 2024 were that interest rates would be between 3.5% and 4.5%, so almost 1% to 2% lower than they are currently, and that has changed. Inflation data has come out, and it's been higher, and that has increased, or it has decreased the potential for rate cuts currently. Now, these will change a lot. I mean, these change every single day. You can go to the CMEgroup.com website and look up future expectations for interest rates. I mean, you can look back and say 1 month ago, here's this, I know it's small on here, there was more likelihood that rates would be lower than they are currently. Kind of see, okay, now the bigger numbers were towards the lower end, and now the bigger numbers are towards the higher end. And again, those you can see how those change on a day-to-day basis, because they do change a lot. So market volatility, I mean, that is, we get a lot of questions around market volatility, and especially downside volatility. I mean, most folks aren't too worried about upside. Hey, when prices are going higher, great. But volatility, just fluctuation around a mean, that it's just a component of the market, and it's definitely not something that is abnormal or should be overly concerning when when we see it. And this graph, what this does is it basically looks at every single year, all of the intra-year declines going back to 1928. So it just saying, okay, a drop that just represents a column on this graph. So there's a lot of data represented here. And then the gray bars, if you can see those, are a little bit lighter colored, but you can see those indicate recessions. And then all of these numbers indicate, some of the recessions that I'm going to talk about, but indicate significant market drops, anything more than a 20% decline. And that's really the fear when volatility picks up, specifically downside volatility picks up. The fear is that we're going to be headed into another recession. And, that is just not the case. Volatility doesn't always indicate recessions. I mean, what indicates recessions, or at least what has worked in the past, is just, okay, where are we in the business cycle? Is the economy expanding or contracting? There's really 4 phases to it. We have the expansion phase, we have the peak, we have the contraction, and we have the trough. Those are the 4 kind of phases to the economic cycle. And all of those dots that were on the previous graph are all indicated here. And I'm circling them because the major market drops that are prolonged in nature have historically always been around recessions. So if we look here, I mean, big drop during the Great Depression, and it lasted 32 months. 1937, I mean, all kind of still tied to that, but Fed tightening, minus 60%, lasted 60 months. And then we had the post-World War II crash, minus 30%, lasted 36 months. Eisenhower recession, 1956, minus 22%, 14 months is how long it lasted until it started to go back up again. 1968, minus 36%, 17 months. 73, 20 months. 1980, 20 months. March of 2000, 30 months. October of 07, 17 months. And then with the most recent COVID recession was only 1 month. But look at the ones that don't have recessions. They're still downside, but the duration is much less. So that's why I talk about recessions in the economic cycle, because these are the ones that are more concerning. How do we minimize those drops during those periods? In between recessions, we're going to have normal market cycles and normal amounts of volatility. There's just typically more of it during recessions. On average, we can see this is a measure of volatility, and this looks at 1% moves either up or down on any given basis in the financial markets, and more specifically the S&P 500. So on average, there's been 64 1% moves up or down per year since 1980. We're currently at 10. We've had 10 this year. But some years you could see it's significantly higher, and doesn't necessarily mean that that's a down year, but you can see some of the big spikes have been during some of the more aggressive pullbacks in the financial markets. And intra-year declines are, again, very normal. On average, a intra-year drop of 14% since 1980, which is, even though we've had positive returns 33 of 44 years, on average, you've seen the market drop 14% from peak to trough. Doesn't even mean the market went negative that year. It just means it dropped at one point. Like, let's just look at the first one here in 1980. Market ended the year up 26%, but at one point during the year, it dropped from wherever the peak was down 17% and finished up 26. And you can see that's what all these red dots indicate, is the peak to trough decline during the year. Currently, market's up 4%. This was as of April 19th. We'd had a 5% pullback from the peak. And I mentioned too, we're going to talk through what I think, some of the most important indicators are. And the one, this was actually one of the bullet points, one of the talking points on the invite, is the most important long-term market indicator. And it is the unemployment rate. We're currently at 3.8%. It does look like it's potentially kind of increasing here. It's actually been very, very steady. More of a nuance with how the data looks, and I'll show you here a graph. But unemployment rate is currently 3.8%. And why is the unemployment rate so important? And it's because of economic growth. Here's the long-term, a zoomed in version. You kind of see that 3.8%. While it looked like it was spiking up here a little bit, it's fairly steady when we zoom in, just as an FYI. Okay, so why is it so important? Well, let's talk about what economic growth is. Well, it's we want to measure the economy and its growth, and one way we do that is utilizing GDP, which stands for gross domestic product. It's the total market value of goods and services produced in the United States in any given year. And, so a way to maybe compare that is, that is almost like it's revenue if it were a business, but, kind of different ways to think about it. So goods, goods are specific kind of products, a video game, a car, an apple, I have those examples, something that that is made, a physical item. A service is just something that someone provides to someone else. So whether it's a doctor, it's what processing your tax return, a CPA or a tax preparer is providing a service. And so it's an action that someone takes for someone else. And then the market value is just the total cost of all those things. So it's what you pay for it. So, GDP just kind of represents all of those things. And when we add them all together, and we can use that to compare to where we were historically, the market is either growing, so it's increasing over time, or the economy is increasing over time, or it's decreasing if this number is getting smaller. And the pace of it impacts jobs, impacts the markets, impacts small businesses, private businesses, impacts what people's view and decisions around investing. And that's why it's, so closely followed. And the number, so we use real GDP, by the way, which means anytime you see the word real in economics, that means it's after inflation. So you take inflation out of it. And the reason is that gives us a better comparison to historical values. So when things inflate, it's, prices are higher, but part of that could just be, there's so many things that impact inflation. So if we want to compare these to a historical basis, we want to take inflation out of it. So anytime we're talking about, hey, the economy grew at 2%, and then inflation is 3%, it's like, well, the gross number is 5, because it's the 5 minus 3 gives us 2, which is the real number, the after inflation number. How is it calculated? So, I mentioned goods and services, is the definition of it. Well, here's the formula: C plus I plus G plus NX equals GDP. Well, what does that mean? Well, C stands for personal consumption. So it's what consumers spend their money on. All goods and services that people, individuals spend their money on. Investment is business spending, and that number includes home purchases. And I've got data here that kind of breaks that out, but that is home values are included in investment. G stands for government spending, and then NX is the net exports. So if we import more than we export, that can take away. If we export more than we input, that is additive to GDP. So I mean, it's just kind of how that factors in. And then the sum of all of those totals give us GDP. So this is Q4 2023. This is the value of all of those components added up. So I mean, we've got a nearly $29 trillion economy, and these are the percentages that were spent during the quarter on those different components. So the NX actually subtracted. We imported more than we exported, so that subtracted from GDP. Consumer spending, nearly 68%. Government spending, 17%. Business, now the investment from businesses, again, and it's inclusive of housing. So if we exclude it, you can kind of see the two different components to it. 3.9% on housing, 13.8% on other investment, excluding housing. This is why the consumer and the jobs market is so important, is nearly 70% of the economy, GDP, of economic growth, is tied to consumption. And if people have jobs, they spend money. I mean, that's the simplest way to think about it. And when money is spent, businesses generate revenue. So whether it's a business that provides a good, provides a service, provides goods and services, that money shows up as revenue to the business. Revenue turns into earnings, and stock values are a function of earnings. So when I talked about the $276 earnings per share, that's what, that's EPS estimates based on corporate earnings. So if we have an expanding economy here, we have jobs we're continuing to add jobs to the jobs market. People are filling those jobs, hopefully. Then they have money to spend. That shows up as revenue, flows through all the financial statements, shows up as earnings. Earnings, again, we have an estimate for future earnings. We apply a multiple to that. That gives us a expected future value for different, whether it's an individual stock, different asset classes, and that's how the jobs market impacts stock prices. And this is a simplistic view. I mean, there's a lot of different factors that kind of influence this, but we want to focus on the big picture items. I mean, you can turn on the TV and be overwhelmed with so many different things, and those things sure might matter to an individual company, might matter to an individual business, a person, but they, by and large, how does it impact the overall economy here in the United States? And that's why, if we were to just simplify things and say, let's look at something that we think is the most important, it would be the jobs market. And when we think about, okay, well, how jobs market and jobs data has been strong. That was one of the things why the market actually started to pull back from the end of March into April, because jobs data came out, more jobs continue to be created. And the fear was that, well, the Fed is now not going to reduce rates because inflation now could be elevated going forward. Because people still have jobs, they're still spending money. So it's almost like you kind of think of it as like, well, that sounds like a good thing. And it's like, yeah, it is a good thing. Short term, markets overly obsessed with inflation and interest rates. This is inflation data going back a couple of years, and it's a heat map. So it just looks at high numbers versus low numbers, and what this visually displays without looking at the individual numbers is that, well, yeah, 2 years ago inflation was high and now it's cooling off. I mean, it's decreasing. It doesn't mean there's no inflation. It just means the rate of inflation is much less than where it was 2 years ago. And that's been, when you look at that too, you kind of say, well, it looks like it's getting pretty steady, which it is. So again, some of that fear that the Fed's going to, either, not necessarily, there's no fear of them raising rates, but more likely them maintaining current rates than they are dropping them based on the most recent information on inflation and the jobs market. Next month, there'll be another jobs report, there'll be new inflation data, and that will impact the Fed's view. They don't just base it on every individual month. They just, they have a long-term view on these things and they have an outlook, but they have to make comments because the market is worried about what's happening on a month-to-month basis, and there's questions about it, and there's press releases and all these things that just kind of overly focus on some of this stuff from time to time. This graph here is just what this shows more than anything. There's a lot of different data points on here, but I want to point out the S&P 500. So it's the value of the S&P 500 following market interest rate peaks. So once the Fed kind of gets to a point and stops raising rates, what happens? Well, forward returns in all these periods have been very strong. May 2000 was a pullback there because we had the tech bubble bursting. But look at all the other ones. On average, past 6 rate hiking cycles, once they've kind of stopped hiking rates, we've had forward returns that have been very strong, very robust. So on the short term, as I mentioned, the market is focused on inflation and interest rates. Jobs market is, as I mentioned, more important long-term indicator, but short-term inflation. This is more of that inflation data going back 2 years, just broken out in a different way with all the components. And this red line, I want to point this out. This is auto insurance. Kind of see here, auto insurance has increased significantly over the last couple of years. Just as a way, I want to point that out. I mean, you're probably seeing that with your auto renewals, and it's primarily because auto prices they've gone up and they've stayed high. There was the issues related to COVID with supply chain, and used car prices went up, and then new car prices went up, and so the prices have stayed elevated, and so autos are expensive. And well, the insurance companies realized they were underinsuring some of these vehicles based on current values and current prices. So you're seeing auto insurance premiums go up, and you're probably seeing that too with your home premiums as well. In similar situation, it's home values have gone up a lot, and pricing within the insurance industry is now trying to catch up to those higher values. The interest rate expectations too. I mean, this has changed, as I kind of mentioned on that previous CME group slide. Earlier this year, interest rate expectations were more of a drop. There's still a market expectation that rates will come down slightly. The FOMC, Federal Open Market Committee, is indicating that rates will be slightly lower than what the market's expecting. So we'll see. The good thing with that is that the market is actually being a little bit more what we call hawkish when they don't. They're hawkish and dovish. Hawkish means just more tight with money, and higher interest rates, versus dovish means a little bit more loose with money and lower interest rates. So the market, if the Fed doesn't lower as much as they think, the market is pricing that in already. And then you kind of see what they say long run is just way out in the future, kind of where they think rates will be. In the unemployment rate, though, if we're going to focus on the long term and major market pullbacks, it's important to just always follow the jobs market, because as we're adding jobs, economy's expanding, things are, from an economic cycle, business, all that. Of course, there's going to be sectors, there's going to be individual companies, they're all going to perform differently, but as a collective whole, this leads to increase in earnings, which increase, or increase in revenue, which typically leads to an increase in earnings. If we start to see job losses, so on a month-to-month basis, the number of jobs added is negative, meaning we're taking jobs away because more companies are laying off than they're hiring. One month of that isn't necessarily concerning, but as we see more and more of that is an indicator that we could be headed into a recession. And not all recessions are created equal. These bars again represent recessions. Some of them are deep and long, and others are just short and almost like we didn't even know what was going on. I mean, markets pull back during them, but the pullback may not be as long and as sustained as others. But the major market pullbacks and the major long sustained pullbacks are always around recessions. So if we can get a handle on that, we can look at the portfolios, and it doesn't mean, okay, everything, we move to cash or we change the entire allocation. There's a lot of analysis that goes into it that says, okay, should we be more defensive with our stock holdings? We own different asset classes that tend to hold up better during recessionary environments. Things such as consumer staples, like it's the money that you or anyone is going to spend no matter what's going on, because you have to go buy groceries, you have to pay your utility bills. For a lot of people, their cell phone, I mean, that's a staple. You have to do it. Your internet service provider, you have to do it. Whereas discretionary expenses like vacations, new auto purchases, things like that, jewelry, don't necessarily perform well during recessionary environments, because you don't have to spend the money on those things. You have to spend it on these others. And so if people have to make a choice because income for them is lower, because maybe, they lost their job or their spouse lost their job and now they're on unemployment while they're looking for a new job, they have to make decisions. And discretionary spending is typically the expense that's going to go. We call it in our planning needs versus wants. We're going to pay for the needs. The wants would be great, but aren't an absolute. And let's not focus. I mean, it's hard not to do. I'm talking a lot about kind of short term, where I think the market's going to be in 9 months from now. And that's, I provide an outlook and a projection. And, the reason I do that is because I want to give people an idea of kind of what we're thinking here at Keen Wealth and what we, kind of expect markets, how to perform, and how we're allocating and positioning portfolios. But the long term is more important than the short term. Because when we put together the financial plans and we're talking about someone's retirement, and even preparing for retirement, I mean, if you're still working and saving, you've got even a longer time horizon. And it's, well, what we know to be true, I mean, this has been the case for, going back on this slide, going back to the 1920s, is that stocks historically have outperformed bonds. That's what this graph represents. We've got compounded annual return. So this is compounded, which is even better. Averages are okay, but compounded returns, that's what we want to be focused on. Compounded returns since this graph, 1926, small stocks 11.8%, large stocks 10.1. That's why when I talk about the S&P 500, that's large companies. Government bonds 5.2%, treasuries bills 3.2%. So this is government bonds on that previous fixed income slide, those are the ones that are more volatile because they're longer term in nature. Treasury bills, that's more of that red line that was more straight, because those mature in less than 1 year. And then inflation, 2.9% since 1926. So if we do nothing, our money loses value. So anytime you see a headline or a chart, or anyone, if you're reading an article, it talks about the value of a dollar has lost 98% of its value. Well, that's what inflation is. I mean, that isn't anything new. I think typically people are using that to almost to sell something, because it's like, yes, if you just kept cash in the bank, not in a savings vehicle, was not earning interest, it's losing value. I mean, if you buried it in the backyard, if you stuck it in the walls of your house, if you put it in your mattress, that money is worth less every single day. I mean, it's worth less in 12 months from now, it's worth less 10 years from now, because that's what inflation does. It eats the value of it. So knowing that, we want to invest money, and we can invest it in short-term, instruments that basically are risk-free. Treasuries, governments don't default. They typically pay their interest. So treasury bills are considered very low risk. I mean, I would, if I had to put it on a scale of 1 to 10, it would be, less than 1 from a risk standpoint, because again, not, no, we haven't had a government default, U.S. government default on any of its bonds or interest. So you put it in that to at least outpace inflation, and that's what it does. So that's, money markets, why we have savings accounts that earn interest, because we're trying to just outpace inflation. Government bonds, you take on a little bit more risk, only because it's longer term in nature. So there's some interest rate risk. You kind of see how, how those fluctuate. That gets you a little bit of a higher return than just leaving it in a money market or CDs or, something like that, because that's basically what treasury bills is representing. And then stocks, we can see, have significantly outperformed both of those two asset classes. I mean, this is $1 invested, and you have significantly more money by investing in stocks, but it doesn't come in a straight line. There's volatility. You see these pullbacks. So that's the volatility, is the cost of these higher returns. And that's why, we have investments in both stocks and bonds for people, because when we're looking at a 30-year retirement, there's periods, I mean, we want to have these higher returns to make sure that folks are outpacing inflation, doing what they want to do, having more money to spend, versus just keeping it in cash for someone's retirement. And especially when interest rates are extremely low, that doesn't do you much of any good either. As time moves on too, I mean, this is since 1950, kind of a different way of looking at it. You can see just a basket of stocks since 1950, average return 11.4, compounded return would be less. Bonds, 5.3. So if you had a mix of 60-40, you kind of see the number there. And that's a growth of $100,000 over any 20-year period, which is a rolling kind of return. What this represents is volatility. So these columns, we have the zero line here, and any given year since 1950, stocks have been as low as 37%, as high as 52%. Bonds, and this is a broad basket of bonds, so a little bit longer term in nature, minus 13% to up 33%, and that's all based on interest rate fluctuations. And then the combination of 60% stocks, 40% bonds, there's the range on any given year. The longer we go out to our holding periods, the tighter those ranges become. Now you can see a 5-year holding period, a 10-year holding period, a 20-year holding period. And what you're noticing is that, yes, the high end is coming down, but also the downside is coming up significantly. So the longer we hold, actually, the less volatility there is. And that's kind of one of the things I want to point out, because volatility is it's a function of investing. And we're going to have periods of volatility. We have it every single year. And just because it's picking up doesn't mean we're headed into the next market crash by any means. So as we progress throughout 2024, we're continuing to watch economic growth. We're watching earnings, the inflation data as it comes out, and of course interest rates. But I think the path higher is that it's all going to be keyed on the jobs market, which is, ties to economic growth, ties to earnings. Inflation is also kind of almost tied to the jobs market too, because if there's more and more jobs and there's less and less workers, that can create wage inflation, which can increase inflation in other areas, which then interest rates are, impacted on that as well. Well, again, thank you all for joining us today on our webinar. Appreciate all of the questions. Check out keenwealthadvisors.com. You can find the replays of previous webinars. And also, one last thing, Keen on Retirement, Engineering the Second Half of Your Life. This is the second edition of Bill's book. If you'd like a copy of that, please send me an email or reply to any of the emails that you receive from us and say you'd like a copy of it, and we'll get that sent out. My email address is mwilson@keenwealthadvisors.com, and you can send me a note, and happy to get this out to you. Well, again, thank you all for joining us today. We had a lot to cover. Appreciate all the questions, and we will get those answered for you in a future podcast episode. All right. Talk to you later.